study of economics considers how people make choices between scarce alternatives to maximise their welfare. An underlying assumption is that we behave rationally, in the sense that the choices we make are logical and in our best interests. We're assumed to be consistent in our decision making, so that if alternative A is better than alternative B, and alternative B is better than alternative C, then alternative A is preferred to alternative C. We also efficiently trade off current consumption against future consumption to maximise well-being over our lives. But while this often malign economic man, or Homo economicus, may be a reasonable description of how we should behave, the reality is that we, that is Homo sapiens, do things that clearly contradict this view of the world and may contradict what is objectively in our best interest. And the idea that we efficiently trade off current consumption against future consumption to maximise welfare requires that we know what our future looks like. Of course, we can't. But there is no possibility of achieving anything like the economist's nirvana of selecting a spending pattern that will maximise your lifetime welfare if you have no idea of what financial resources are likely to be available to you to fund that spending. FinHealth considers that to achieve and maintain the good financial health goal of financial independence, it's important to make best guesses of what your desired lifestyle looks like. Assess its consistency with your expected financial resources and, if necessary, make appropriate adjustments. The rest of this video focuses on what we call your projected lifetime investment wealth, which is a key concept that emerges from this lifetime approach to financial planning. Without a reasonable estimate of your projected lifetime investment wealth, it's our view that it's impossible to sensibly respond to such important personal finance questions as: what is my current asset allocation? How much can I afford to borrow? And are my lifestyle expectations achievable? Hi, I'm John Lesky, recently retired personal financial advisor and founder of finhealth, a tool to guide you to your financial independence. Now, we've discussed projected lifetime investment wealth in previous video blogs, particularly in the What is FinHealth series. It's introduced in the retirement expenditure multiple and is the denominator for the calculation of FinHealth financial health indicators, the tax effectiveness ratio and the growth asset allocation ratio. But we consider that it's such an important concept that it's worth its own video blog. So, what is projected lifetime investment wealth? It's a best estimate of your total expected investment wealth at the time of your desired retirement and/or financial independence. It's the investment wealth you are projected to have to fund your desired retirement lifestyle. It's calculated as the sum of your current net investment wealth plus your expected future savings from now to retirement or financial independence. If you're already retired or financially independent and are relying totally on your investment wealth to support your desired lifestyle, projected lifetime investment wealth is equal to current investment wealth. That is, expected future savings are zero. Your expected future savings are the difference between 1. Your expected after-tax employment and/or self-employment earnings, plus any sizable receipts from third parties, for example, an anticipated inheritance, and sales of lifestyle assets, for example, proceeds from downsizing an existing residence, less 2. Your expected ongoing spending to retirement or financial independence, plus any significant once-off payments to third parties, for example, assistance to adult children to buy a home, plus purchases of lifestyle assets, for example, a major renovation. In the finhealth framework, a concept called future capital is defined as the total of the annual cash flows that comprise expected future savings, assuming that there is a 0% after inflation and after-tax return earned on those cash flows. Projected lifetime investment wealth is then current net investment wealth plus future capital. Now, there are some important features of projected lifetime investment wealth that are worth noting, including, first, its amount isn't dependent on age or time to desired retirement or financial independence. It's driven by a combination of your current net investment wealth plus your future capital, or what you can save between now and your retirement or financial independence date. For those early in their careers, current net investment wealth may not be significant and may even be substantially negative if there is a large mortgage. But expected future income increases over a long career will often mean future capital makes up most, if not all, of projected lifetime investment wealth. On the other hand, those late in their careers with limited years of future savings ahead of them could have the same projected lifetime investment wealth estimate as early career colleagues. But current net investment wealth, rather than future capital, is the major component. In finhealth's view, a second key feature is that projected lifetime investment wealth should serve as the measure of total investment wealth when calculating your current growth asset allocation, rather than current total investment assets or current net investment wealth. But accepting this raises the question of whether to treat future capital as a growth asset or a defensive asset. Our approach is to classify it as a defensive asset, as future savings are initially revealed as increases in cash holdings, but it's acknowledged that its calculation is fraught with uncertainty. The amount of uncertainty will vary from household to household and is heavily dependent on the reliability of the income projections. For those with highly uncertain income expectations, it may be appropriate to apply a discount factor to their future capital estimate, for example, say 25%, for asset allocation purposes. The effect of applying a discount to future capital will be to reduce the estimate of projected lifetime investment wealth and, therefore, increase the calculated current growth asset allocation ratio. Such uncertainty regarding future capital appropriately feeds into a requirement to hold less risky growth assets to achieve a target growth asset allocation ratio, compared with the situation where there is a high level of confidence in the future capital estimate. And finally, a third feature is that in assessing and improving your financial health, your projected lifetime investment wealth should be a primary focus. Unlike investment returns that you have no control over, you have significant influence over the future capital component. For example, it can be increased by one or a combination of increasing your projected pre-tax earnings, decreasing your projected ongoing spending, working longer, reducing any expected future once-off spending on lifestyle assets, or reducing any expected significant net payments to third parties. To a greater or lesser extent, you can directly influence all these variables. The finhealth personal finance software is a useful tool for those who aren't already retired and/or financially independent to better understand their current projected lifetime investment wealth and how changes in assumptions will affect it. To illustrate, the key measures report for the Barbers, the case study family used in our What is finhealth series of video blogs, is shown on the screen now. The projected lifetime investment wealth, calculated from the provided inputs, is highlighted in the red box at $2.266 million, and with current net investment wealth at $0.8 million, implied future capital, that is, expected future savings to retirement or financial independence, is $1.466 million. The current tax effectiveness ratio at 35.3%, highlighted in the green box, is calculated as current total superannuation of $0.8 million divided by projected lifetime investment wealth of $2.266 million. The current growth allocation ratio at 39.7%, highlighted in the purple box, is current growth assets of $0.9 million divided by projected lifetime investment wealth of $2.266 million. The report reveals that, based on the assumptions, the Barbers are below the finhealth benchmarks, both on a current and projected basis, for all 5 of the key indicators of good financial health. The conclusion is that the Barbers are unlikely to achieve their version of financial independence without some adjustments to their expectations. This is the picture also suggested by their personal financial dashboard, shown now, which reveals a steeply declining investment wealth ratio and retirement expenditure multiple after retirement. So, let's see how some modifications to those personal finance variables that are most directly influenced changes both projected lifetime investment wealth and overall projected financial health. The revised key measures report, shown now, assumes pre-tax income projections for Peter and Susan are 5% a year higher than initially projected. Ongoing spending is 5% a year lower. Peter and Susan work 2 years longer, and the amount allowed for a residence upgrade is 5% less. Projected lifetime investment wealth increases to $4.02 million, a 77% increase. The current tax effectiveness ratio falls to 19.9%, and the current growth asset allocation ratio to 22.3%, both declines reflecting increased projected lifetime investment wealth. The above benchmark projected investment wealth ratio and retirement expenditure multiple indicate a significantly more healthy financial outlook, as confirmed by the revised personal financial dashboard. The Barbers' improved financial health is a product of changes in lifestyle expectations that increase projected lifetime investment wealth, rather than a reliance on taking more investment risk or lucking out with higher investment returns. That doesn't mean you should ignore good investment practices. Far from it. And the tax effectiveness ratio, the growth asset allocation ratio, and the investment diversification ratio embody these. However, good financial health is more likely to be achieved by a focus on the things you can control, rather than guessing what investment markets are going to do next. Your projected lifetime investment wealth is largely in your hands. Hopefully, you found this video of interest. I'd like to know what you think. Please provide any comments or questions below. Finally, thanks for watching.